February 13th, 2026. 14 days ago, silver was trading at $121.67 per ounce, an all-time record high in the history of human civilization. Not a record for 2026, not a record for this decade, an all-time record, ever. And then, in less than 24 hours, it crashed to $74. Let me say that again so it truly sinks in. $121 to $74 in one day. That is a collapse of 39%, the single largest one-day drop in silver since March 1980, 46 years ago. And right now, as you watch this, silver sits at $82.50, 32% below that peak, struggling to hold a floor, with the whole world watching. Now here is the paradox that should be making your head spin. If you tried to buy physical silver during that crash, actual coins, actual bars, actual metal you can hold in your hand, you couldn't get it at $74. You couldn't get it at $82. In Shanghai, physical silver was still trading at $120, while the COMEX paper price was at $74. That is a 54% premium between the paper price and the physical price on the same day. Think about what I just said. The paper market and the physical market were $46 apart on the same asset at the same moment in history. If you own silver, if you are thinking about owning silver, or if you simply want to understand what is actually happening in global commodity markets right now, stop what you are doing and watch this entire video. Because the official story you have been given by the Treasury Secretary of the United States, the explanation that has been repeated across every newspaper and every news channel over the last 2 weeks, is not the complete picture. On February 10th, Scott Bessent stood in front of cameras and told the world that what happened to silver was a speculative blow-off caused by unruly Chinese traders. And by the end of this video, you will understand exactly why that explanation is only half the story, who was actually on the other side of that trade, what the real structural crisis in silver is, and critically, what is most likely to happen next. Let's get into it. Welcome back. If you are new here, this channel covers the silver and precious metals market with real data, real numbers, and real analysis. We do not do vague predictions. We do not say silver might go up someday. We give you specific facts and let you draw your own conclusions. Before we go any further, if you find value in this kind of analysis, subscribe now and hit the notification bell. This content is time sensitive and you need to see it when it drops. Now, back to what just happened. Let me take you back to the beginning of January 2026, because to understand the crash, you have to understand the rocket. Silver entered January 2026 trading at around $73 per ounce. That was already elevated, up more than 100% from where it stood in early 2025. Most mainstream analysts were calling it overvalued. Most of Wall Street had silver pegged somewhere between $30 and $40 as fair value. What happened next was extraordinary. In the first 29 days of January alone, silver gained 68.5%, rising from $73 to $121.67 on January 29th. To put that in context, that is the kind of move that gold makes in a decade. Silver made it in a single month. The gold-silver ratio, which had hovered near 80-1 for years, crashed to 30-1 at the peak. That is a seismic shift in the relationship between these two metals that usually takes generations to occur. And then, January 31st. In a single trading day, silver fell 31.4%. Not 5%, not 10%, 31.4%. It hit an intraday low of $74 per ounce. Billions of dollars in leveraged positions were wiped out in hours. Margin calls cascaded across exchanges from Chicago to Shanghai. The CME, the Chicago Mercantile Exchange, had raised silver margin requirements twice in 2 weeks, first from 7% to 9%, then from 9% to 11%, creating a mechanical trap for every over-leveraged long position in the market. By February 1st, silver had stabilized around $80. Today, as of February 13th, it's hovering at $82.50. Now, here is where Treasury Secretary Scott Bessent enters the story. On February 10th, 2026, Bessent made a very specific statement. He called the entire silver rally a speculative blow-off. He pointed the finger directly at China, specifically at Chinese retail and institutional traders who had used extreme leverage to drive prices higher. He suggested that when Chinese authorities tightened margin requirements on domestic exchanges and suspended the primary Chinese silver ETF, the UBS SDIC Silver Futures Fund, the air simply came out of the bubble. And on the surface, he is not wrong. Chinese traders were highly leveraged. The UBS fund was suspended. Chinese exchanges did raise margins. All of that is verifiable and true. But here's the thing. Blaming China is the explanation that is convenient for Wall Street. It is not the complete explanation. And the complete explanation is what I'm going to walk you through right now. Because the real crisis in silver has almost nothing to do with Chinese speculation, and almost everything to do with a structural problem that has been building quietly for years, and that the crash of January 31st has made significantly worse. Wait until you hear what I am about to show you. Let me explain something that most financial channels will not take the time to explain properly, because it requires you to understand that there are effectively two different silver markets operating simultaneously, and they have been diverging from each other for years. The first market is the paper market. This is COMEX in New York. This is futures contracts. This is ETFs. This is the price you see on your phone when you search silver price. It is a market dominated by financial instruments, contracts that represent silver, but in most cases will never result in anyone actually taking delivery of physical metal. Traders buy and sell these contracts to speculate on price direction. Most positions are closed before delivery. The actual physical metal almost never changes hands. The second market is the physical market. This is actual silver, bars, coins, bullion, the metal that goes into solar panels, AI data center hardware, electric vehicles, medical devices. The silver that governments, central banks, and industrial users actually need to take delivery of. These two markets are supposed to track each other closely. The paper price is supposed to reflect physical supply and demand. The problem, and this is the problem that Bessent is not talking about, is that they have been decoupling for months. And on January 30th, that decoupling became impossible to ignore. Let me show you the numbers, because the numbers are everything here. As of early February 2026, COMEX registered silver inventory, the metal actually available for delivery, stands at approximately 103.5 million ounces. That sounds like a lot, but here is the critical context. Open interest on COMEX, the total number of futures contracts outstanding, represents approximately 1.586 billion ounces of silver. That is a leverage ratio of approximately 14 to 1. For every ounce of physical silver sitting in a COMEX vault, there are 14 paper claims on that silver. Let that sink in, and it gets worse. Those COMEX inventories have fallen by over 70% since 2020. In 2020, COMEX held over 350 million ounces of registered silver. Today, that number is 103.5 million. The physical backing of the entire COMEX paper market has been draining, quietly, steadily, month after month, for 5 consecutive years. Now pay close attention to what was happening in Asia while that paper market was being smashed. When silver crashed to $74 on January 30th, physical silver in Shanghai was still trading at $120 per ounce, a 54% premium for the same metal on the same day. In India, physical premiums were running at $8 per ounce or more above spot. In other Asian hubs, the story was identical. The physical market refused to fall with the paper market because the buyers of physical silver knew something the futures traders in New York seemed to have forgotten. You cannot manufacture physical silver out of a computer. You either have it or you do not. Let that sink in, because that gap, that $46 spread between the paper price and the physical price, is the single most important data point in this entire story. It tells you that when the financial noise was stripped away and real buyers tried to acquire real metal, the price was not $74. It was $120. Now let me bring in a piece of the story that the Bessent narrative conveniently omits entirely. On January 1st, 2026, exactly 30 days before the crash, China implemented strict export licensing requirements on refined silver. This policy effectively ring-fenced 60 to 70% of global refined silver supply for domestic use. China is both one of the world's largest silver producers and one of its largest consumers, primarily for solar panel manufacturing at a scale the Western world has not yet fully grasped. When China locks its silver inside its own borders, the rest of the world has to compete for the remaining 30 to 40% of global supply. Now, here is where it becomes truly remarkable. Treasury Secretary Bessent blamed Chinese traders for the speculative rally, yet China's own government was simultaneously restricting silver exports to protect its domestic supply. Ask yourself honestly, does that look like a country that thinks silver is in a speculative bubble? Or does it look like a country that thinks silver is going to be critically scarce? Think about what I just said. Read that again if you need to. Because those two things cannot both be true at the same time. Here is what I consider the single most important number in this entire video. The global silver market ran a structural deficit of 117 million ounces in 2025. That means the world consumed 117 million more ounces of silver than it produced. But that was not a one-off bad year. 2024 had a deficit, 2023 had a deficit, 2022 had a deficit, 2021 had a deficit. 5 consecutive years of consuming more silver than the mines can produce. The cumulative deficits since 2021 add up to approximately 820 million ounces of silver that has been drawn down from above-ground stockpiles to meet real-world demand. And for 2026, the Silver Institute projects a further shortfall of 67 million ounces. And that projection was made before the January rally pulled even more industrial buyers urgently into the market. On top of all of this, the Shanghai Futures Exchange reported that its silver inventories have plummeted by nearly 90% from 2021 levels. Not 10%, not 20%, 90%. The physical buffers that once absorbed supply shocks are essentially gone. Now bring all of that together and hold it in your mind while I tell you what actually triggered the January 31st crash, because the timing of what happened tells a very specific and important story. The catalyst that mainstream media pointed to was a single piece of political news: President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is known as a hawk, someone who favors higher interest rates and a stronger dollar. Higher interest rates mean higher yields on bonds, which competes with non-yielding assets like silver. A stronger dollar makes silver more expensive for international buyers. The moment that nomination was announced, algorithmic trading systems in New York began selling silver futures. That is what triggered the cascade. And here is what is critical to understand. The selling happened almost entirely during US trading hours. The data is unambiguous. When the New York session opened and the Warsh news hit the wires, silver began to fall. As prices fell, the CME margin requirements, already elevated from 2 previous increases, began triggering automatic margin calls on leveraged long positions. Those margin calls forced liquidation, which drove prices lower, which triggered more margin calls, which forced more liquidation. It was a mechanical avalanche, and once it started, nothing could stop it. Meanwhile, in Asia, what was happening? While paper prices in New York were being driven toward $74, physical buyers in Shanghai were still paying $120 for actual silver. Indian dealers were reporting physical premiums of $8 per ounce above whatever the spot price said. Reports from Middle Eastern bullion dealers described continued strong physical demand throughout the entire crash period. Stop for a second. Think about this. This is the pattern that market observers have documented repeatedly over recent years. Western paper markets sell, Eastern physical markets buy. One side sells promises, the other side hoards metal. And the CFTC, the Commodity Futures Trading Commission, published data showing that as of early December 2025, commercial banks collectively held over 200 million ounces net short in silver futures. 200 million ounces. Banks that are short silver benefit from falling prices. They profit when silver goes down. They are, by the structure of their position, incentivized to sell. Let that sink in. This is not a fringe conspiracy theory. It is published regulatory data. 200 million ounces short, sitting on the other side of the trade from every silver holder in the world. Now, I want to be precise here, because intellectual honesty matters. I am not telling you that what happened on January 30th was a coordinated manipulation in a provable legal sense. I cannot prove that with certainty, and I am not going to make that claim. What I can tell you is that the structure of the market, extreme leverage, 14-to-1 paper-to-physical ratios, repeated margin hikes, $200 million ounces in commercial short positions, and a single political headline as a catalyst, creates conditions where massive, rapid price declines can occur that have very little to do with the underlying physical supply and demand picture. The mechanics were in place. The trigger arrived. The avalanche fell. Whether that was coincidence or calculation, the result was identical. And the people who needed to buy physical silver at the bottom paid $120 for it regardless. Now let me give you the historical context that puts all of this in perspective, because history does not repeat, but it does rhyme with remarkable precision. In 1979 and 1980, the Hunt brothers of Texas famously cornered the silver market, driving prices from $6 to $50 per ounce. When exchanges, including COMEX, changed the rules mid-game, raising margin requirements dramatically and restricting new long positions, the market collapsed. Silver fell 80% in weeks. The Hunts were financially destroyed. The 2026 situation shares structural similarities: a parabolic rally, extreme leverage, exchange-driven margin hikes. But there is one critical difference that changes everything. The 1980 Hunt Brothers corner was almost entirely speculative. Silver at the time was not running a structural supply deficit. The industrial demand backdrop was nothing remotely like what exists in 2026. Today, the underlying physical market is genuinely tight. The solar panel industry alone consumes hundreds of millions of ounces annually. AI data center infrastructure requires silver for its superior conductivity in dense computing environments. The electric vehicle transition is accelerating globally. These are not speculative demand drivers that disappear when sentiment turns. These are industrial users who must have physical silver, regardless of what the COMEX futures screen says. That is the difference between 1980 and 2026. That is the difference between a speculative blow-off and a structural crisis that happens to also attract speculation on top of it. Now I want to speak directly to three different kinds of people watching this, because depending on your situation, the right response to what has happened is genuinely different, and you deserve an honest assessment of each. If you are scared right now, if you bought silver during the January rally, if you watched the price run to $121 and felt validated, and then felt gut-punched when it crashed to $74, and if your instinct is to sell and stop the pain, I understand that completely. It is a deeply human response to financial loss. But let me give you the data you need to make a rational decision rather than an emotional one. The physical silver supply situation has not improved since the crash. The 5-year deficits are still running. The COMEX inventories are still at multi-decade lows. China's export restrictions are still in place. The industrial demand from solar, AI, and electric vehicles has not decreased. The crash was driven by leveraged futures liquidation and a political headline about a Fed chair nomination, not by a fundamental improvement in silver supply or a sudden discovery of a giant new silver mine. If you bought silver as a long-term hold against currency debasement and genuine supply scarcity, the thesis has not changed. The price has. The thesis has not. If you are confused, if you are newer to precious metals and you genuinely do not know what to make of a market that gains 68% in a month and then loses 32% in a single day, here is the framework that will help you think clearly. Silver has two personalities. It is simultaneously an industrial metal and a monetary metal. When industrial demand is strong and supply is constrained, which it is right now, the industrial personality supports price from underneath. When speculative money piles in and then flees, as it did in January, the price can move far beyond where fundamentals justify and then correct violently. The crash you witnessed was the speculative personality overreaching and then retreating. The industrial and monetary personality, the one backed by real supply deficits and real physical scarcity, is still very much present at $82. The two-price world that emerged on January 30th, paper at $74, physical at $120, tells you something profound about where the physical market values the metal when there is no speculative distortion. That physical price was $120. Today's $82 sits between those two extremes and arguably reflects a more honest blending of physical reality and futures market dynamics than either extreme. And if you understand what is actually happening, if you have done the reading, if you see the inventory data, if you understand the China policy piece, if you recognize the 14-to-1 leverage ratio for what it is, then you are looking at $82 silver with a very different set of eyes than the retail investor who only watches the price ticker. You understand that the February 27th first notice date for March COMEX contracts is approaching, and that the mathematics between registered inventory and outstanding open interest remains deeply, structurally problematic. You understand that every day of deficit consumption moves above-ground silver stockpiles closer to a point of genuine, unavoidable crisis. You understand that the Eastern buyers who were paying $120 for physical silver during the crash did not stop needing silver because the paper price fell. For you, the current price environment is simply data, and you know what to do with data. So where does silver actually go from here? Let me give you the honest range of scenarios the data supports, without pretending to know the future with certainty nobody possesses. The base case for most mainstream analysts is continued consolidation somewhere in the $80 to $90 range. The speculative excess has been purged. The Warsh Fed chair expectations have reset the interest rate environment. Silver needs to rebuild a foundation of support before it can mount any meaningful recovery. The $82 level has held as short-term support. Multiple analysts identify $80 to $85 as a credible floor given the ongoing physical deficit backdrop. That is the calm scenario. The second scenario is another leg lower, testing the $65 to $70 range. If U.S. inflation data due this week comes in hotter than expected, or if the dollar strengthens further on hawkish Fed expectations, another wave of futures liquidation cannot be ruled out. The leverage in the system was extreme, and it is not certain that every over-leveraged position has been fully cleared. A test of $65 to $70, while painful for holders, would not invalidate the long-term structural thesis. And, historically, the deepest corrections in structural bull markets create the most significant accumulation opportunities. The third scenario is a recovery toward $100 and beyond, driven not by speculation returning, but by the physical delivery dynamics tightening further. If the March COMEX delivery cycle does not resolve smoothly, if registered inventories continue to drain and open interest fails to roll over, a physical delivery squeeze could reassert pricing pressure from the ground up. Physical buyers who stepped in at $74 and $78 during the crash have demonstrably strengthened the floor. China's export restrictions have not been lifted. The 2026 deficit of 67 million ounces predicted by the Silver Institute has to be met by physical supply from somewhere. And at $82 per ounce, the economics of new mine development are still not compelling enough to meaningfully accelerate production within the next 12 to 18 months. Here is my honest assessment of this moment in the silver market. The official narrative, speculative Chinese blow-off back to normal, is the simplest story, and it is not entirely wrong. There was speculation, there was Chinese leverage, there was a bubble element sitting on top of the fundamentals. Nobody should deny that. But the structural story, 5 years of deficits, a 70% drain in COMEX inventories, China locking up its own supply, industrial demand that is non-discretionary and growing, that story did not end on January 31st. It continued, quietly, underneath the noise. The paradox we opened with, price crashing while physical buyers paid a premium, has not resolved. It has only become less visible because the speculative overlay has been stripped away. But if you look underneath, at the actual metal in the actual vaults, the picture is more strained today than it was a month ago. Let me leave you with this one final thought. The Hunt brothers tried to corner the silver market in 1980 with borrowed money and leverage. When the exchanges changed the rules on them, they were destroyed. What is happening in 2026 is fundamentally different. The scarcity is not being manufactured by two brothers in Texas with a telephone and ambition. It is being manufactured by 5 years of industrial demand outstripping mine supply, by China's export policy, by the global energy transition, by the artificial intelligence infrastructure build-out. It is structural. And structural problems do not resolve because a futures market had a bad day. They resolve when supply and demand physically balance. And right now, that balance is nowhere in sight. Watch this space. The next 60 days, with the March COMEX delivery cycle, the U.S. inflation data, and the continued physical market dynamics, are going to be extraordinarily informative about which direction this market is truly headed. If you want to stay ahead of it, subscribe now. I will have a dedicated video on the March delivery situation within the next week, and you do not want to miss it. And tell me in the comments, do you believe the silver crisis is over, or is this a pause in something much larger? I want to hear where you stand. Until next time, stay informed, stay rational, and do not let the noise drown out the signal. Sonnet 4.5. Extended Claude is AI and can make mistakes. Please double check.